Yes, we are live. Hello, everybody. Welcome to another TradeZero live session. We are excited to have Peter Tuchman, aka Einstein of the Wall Street, with us today. We are excited to hear the market insights. There was lots of going on in the markets. We cannot wait to hear from Peter. Hi, Peter. How are you doing today?
I'm very well. Thank you very much. Good market today. It's happy Friday, everybody.
Happy Friday, everyone. Um, Before we jump on about talking about the markets, I would like to remind everyone, please do ask questions about markets. Peter is always happy to answer. Peter, last night we've been waiting for the Bank of Japan's not the interview, the release about the interest cuts, which could affect the yen carry trade. Also today we had Powell's speech, so lots of things going on about the markets. We're excited to hear what's happening in the market, and as an investor, as a trader, what can we expect from following weeks.
I appreciate it. Thank you, everybody. Welcome, welcome, welcome. I think last week we got cut off. So I'm going to just go back for a little bit, and then I'm going to talk to you about what's really been happening this week. Let's go back to about 10 days ago. We had all eyes were on the Federal Reserve for their meeting on that Wednesday, probably 10 days ago. Today is Friday. So last Wednesday, the Wednesday before, probably about 10 days or 14 days. All eyes were on the Federal Reserve because what we've been waiting for is what ended up happening today. We have been waiting for some clarity out of the Federal Reserve about cutting rates. That's what the market has been toying with since January for the longest time. And we've spoken about it every Friday, right? In January, looking at 7 rates, 5 cuts, 5 cuts, 3 cuts, 2 cuts. Then the economic data was not supporting the cuts. So we started to think about staying the same or raising them. In fact, the bottom line is having higher rates for longer is putting heavy weights on the market, heavy weights on real estate and on the consumer, on credit card debt and all that kind of stuff. We know how we got here. We know that we ended up having to raise interest rates to combat the inflation. Raising interest rates takes money out of the money supply, okay, which is a way that the tool that the Federal Reserve uses to combat inflation. Inflation was caused by COVID, by the printing of money, by all the interruption of the supply chain that happened during COVID. I don't blame anybody, but I blame COVID. The bottom line is we know what happened. In order to take money out of the supply and curb the inflation that we had, we raised 18 consecutive times. Then we got to a point where we needed to really figure out what is the next move here. We can't stay higher for longer. Think about it. For many, many years, we were at zero interest rates that the Federal Reserve classifies are basically the price that banks and banks to Fed borrow money for, right? The banks and companies are able to borrow money at zero interest rates here in the U.S. for a long time, not any longer. Now it's 5+%, but for the longest time, that was a zero interest rate premium, and that's what helped fuel the whole tech craze over the last 5 years, okay? That is one of the biggest contributing factor over the last 10 years, to be perfectly honest. When companies need money for research and development and you have a zero interest environment, then you're able to borrow money bank to bank, bank to company, bank to Fed, company to Fed, all those relationships, and that fuels and grows the economy. It takes it to where we've been, taking markets to record highs. Obviously, in January, after we had these consecutive interest rate raises, it was time to reevaluate the situation and realize that it was starting to really eat away at the state and the health of the consumer. And so we needed to start looking at cutting rates. Well, the idea of cutting rates as a tool by the Federal Reserve needed the economic data. The Federal Reserve tells us time and time again that it's a economic data-driven decision. And the data was just not there to get the rates to be cut yet. However, way back in January, we were looking at the data was setting up for 7 cuts, 5 cuts, 3 cuts, 2 cuts. And every time the economic data started to get worse, the amount of cuts that were projected for 2024 kept getting lower and lower and lower. There was a period of time in March when the market was so robust and doing so well that we were actually thinking of raising interest rates to get things back in check, but that wasn't the case. Then we had April. You and I have spoken about April for the longest time. That was the month after the greatest quarter since 2019, I guess. And we had a pullback, right? And that was the pullback that kind of took the market a little bit off guard, and we had a 10% pullback. Very good, very healthy for the market. We saw a lot of the high-flying tech names come in, and that was an opportunity, right? I know we saw it last Monday, and we saw it back in April. People watch markets go up, and up, and then when they finally have a day or a week or a month where they suddenly consolidate and they pull back, as opposed to people having a shopping list where they take the companies that they like that were very expensive, and as opposed to running from the movie theater screaming and yelling with your hair on fire, and obviously you can tell me I've had my hair on fire a few times, this is a time to look at the market for opportunities, net, over time. Markets do nothing but go up. Yes, we've had a pullback at 29 and 87 in 2000 and 2007, and during COVID in 2020. In 120 years, we've had 5 crashes. 5, give or take, 5, 6 crashes, really, and I don't use the word lightly. So if you think about it, these were opportunities to get into the market. The market over time historically goes up. That's what it does. But we do see pullbacks, and we have seen, but think about it, over 120 years, 5 crashes, that's a very little ratio relative to what's going on. So you have, let's go back to where we were. So we've had higher rates for longer, and the goal was that if the economic data would support it, that the Federal Reserve was ready to start cutting rates to get ourselves back in track, to start getting a little bit of a handle, and to work with the consumer to really not have interest rates higher for longer. That was the goal, okay? These are all the tools that the Federal Reserve, raising interest rate was a tool, and as are the same way lowering them are. But the decision on the upside and the downside have to be based on real economic data. And we just haven't had the data for a while. PPI, CPI, CPE, ISM, all of these numbers, labor markets, unemployment, were not pointing in the right direction for us to be able to satisfactorily signify the cut that we were looking for.
Yeah.
So the Federal Reserve has been toying with our emotions for a while, dangling like a carrot that cut in front of us, and we've been waiting for it, anticipating it. By now, we are really impatient, and we really want it. And the market economic data has finally supported it. Let's go back to 10 days ago, Wednesday. The Federal Reserve, the last meeting of the Federal Reserve, was an opportunity for the Fed to cut rates. We thought maybe they were going to do it, or at least give us some clarity on the dissemination of the information that when we were going to get it and how big the cut was going to be. But we came into that meeting and we came out of that meeting, and the only thing that was significant that came out of that meeting was the Federal Reserve said, Jay Powell said, and I'm a fan of Jay Powell. I got no problem with Jay Powell. Mm-hmm. He's done a great job. Think about it. He got us through COVID. He got inflation from 8.5% to 3%. That's a huge goal. So if you don't like him, I think you got it wrong. The bottom line is the guy's done an amazing job. Mm-hmm. Okay? If it wasn't for the printing of the money and the stimulus that we did during COVID, we'd be on bread lines. And if we were still at 8%, we'd be in deep trouble. He got it from 8% to 3%. This is all the tools of the Federal Reserve. So people should research and investigate and realize that he's done a really great job. All that being said, last Wednesday, but look, he's a human being. Sometimes he misses opportunities. Yeah. And some people think that last Wednesday, the last Federal Reserve meeting, which was 10 days ago Wednesday, we didn't get the cut we wanted, and we did not get the clarity around when the cut or how big the cut was going to be. We walked away from that meeting with the only little bit of a jewel that we got from it was, until we see the economy heading back towards 2% inflation, which has been the goal since the beginning, until we see the trajectory head back towards 2%, we're not going to get a cut. Well, that didn't make anybody happy, and that made everybody frustrated and really pissed off, excuse my language. So we walked away from that meeting on Wednesday, and that was the day that we started to see rotation in the tech sector. People started seeing that they had made a god-awful amount of money in this Magnificent Seven. They had a major rally in all the tech names, the Microsoft, the Micron, AMD, NVIDIA, Amazon, all these names were become major high flyers. The Magnificent Seven really had rallied majorly off their bottom. So what ends up happening when there is a little bit of dissent amongst the ranks and non-directionality by the Fed, well, people do what's called rotation. they decide to take the high-flying stocks that they have good profits in and sell those. And we saw a rotation out of the high-tech names into Russell and into gold. Gold was a safe haven because we know that there's a couple of global wars going on, and the Russell is a mid-cap and small-cap instrument where there's a lot of value, because it's hard to pay $1,200 for NVIDIA when a year ago it was $108. It's hard to pay some of these prices for these high-flying stocks. So people decided to rotate, sell the ones they were in, and rotate their money in. That's all fine and good. But what ended up happening after this disgruntled Wednesday meeting was we looked at Friday. Friday was the next tranche to give us information on making our decisions. Friday, we were looking for 177,000 job-created, non-payroll job creation. We only ended up getting 114,000, a very disappointing number. So you had a really bad meeting on Wednesday. Everybody left impatient and angry. You had a really disappointing number that came out on Friday. It was a summer weekend. Okay, you had the weekend of wars, right? You had a lot of heightened alert around the world about the war between Iran and Israel. There was a lot of fear about further attacks. You had the Japanese stock market. The Japanese stock market crashed that weekend, down 13%, the largest sell-off in history since 1987. Okay. Also had the carry trade, and I'll explain the carry trade separately for a minute. But so you had a bad meeting on Wednesday, a bad economic number on Friday. You had the war mongering about Iran and Israel. You had the Tokyo Stock Exchange crashing. You also had the Tokyo stock market raising interest rates from 0 to plus a quarter. Now, I'm going to take this opportunity to explain to you the carry trade. So I told you for the longest time, we had 0 interest rates where companies can and bank to bank could borrow money for 0 premium. That is what fueled our economy. Well, the Bank of Japan had interest rates up until last week of 0 for a long time. So you saw that governments and institutions and high wealth and hedge funds were borrowing money, okay, from the Bank of Japan. They were hedging it by shorting the yen to hedge their position. They were taking that money and investing it in the U.S. equity market because our market was going up, so that they were long equities, short the yen, and they had a lot of into it with 0 interest rates, hoping to make a quarter of a point. That was a huge trade that was being carried by large institutions, hedge funds, high wealth people into the trillions of dollars for the last year and change. Well, what happened was, unbeknownst to everybody, the Bank of Japan decided to raise interest rates to plus a quarter. Suddenly, that trade that was a guaranteed of a profitable trade was no longer a guaranteed profitable trade, because interest rates went from 0 to up 25 cents. Suddenly, everybody who had this trade on was forced to unwind the trade. If I'm long equities, short yen, and I'm long huge U.S. equities, and I have to unwind this trade, I have to sell all of my U.S. equities and cover my yen. Well, what ended up happening, that also happened over that weekend. Bad Wednesday, bad economic data, war with Israel and Iran. The VIX, also the fear index, went from 20 to 65. So over the weekend was the Japanese crash, okay, raising of the Japanese stock market interest rates, okay, the raising of the VIX, the war in Israel, bad economic data in the United States, the unwind of the carry trade, meaning that after they raised interest rates, the Bank of Japan, everybody who had this trade on had to sell U.S. equities. We all show up to work on Monday morning. You'll all remember it, I'm sure, if you're trading or investing in the market. It was that day that people are calling the crash, but it was not really a crash. It was just a major sell-off. And we came in on that Monday morning, and the market was down 256 handles. Okay? The Dow was down 8,000 points, right? So it was what I call the perfect storm. It's very important when markets sell off in that kind of a fast and furious fashion. That's what I do for a living. I'm a forensic broker. I try and analyze why markets do what they do. It's much more important to understand why it happened that it happened at all, right? Markets go up, markets go down, right? That's what markets do. But it's important, if you're a trader, you're an investor, or you just have an interest in economies of the world, to understand why something happened. So that's because fundamentally, nothing really changed from 3 weeks ago when the markets were trading at record highs across the board to last Monday. Nothing major happened except what I described as the perfect storm, which were small little bits, small components of things that are affecting the global economic landscape that caused that major sell-off on Monday morning. What's important to note is that the opening print on Monday morning was the low of the day, and that was the most recent low. Two scenarios are possible. The market could have opened down 256 handles, equivalent to a massive sell-off across the board, 1,000 points on the Dow. And then if things were really different than they were before, things had basically changed, then the market would have continued to sell off and we would have been down 500 handles on the S&P and 2,000 points on the Dow. But that was not the case. We spent the rest of the day clawing back the S&P 500, the spiders, and we closed out the day. Yes, we closed the day down 1,000 points on the Dow, but we were able to get back half of our losses by the close of business on Monday. Then the scenario is, well, what happened on Tuesday? Is anything fundamentally different than it was 3 weeks ago when the market was trading at record highs? The answer is no. So we come in on Monday morning, on Tuesday morning. The question is there going to be follow through on the sell side, or are we going to have follow through on the buy side? Right? What is really going on? Has anything fundamentally changed? Well, it turned out nothing had fundamentally changed. The market realized that finally, even though Siegel, the great economist, was calling for an emergency Fed meeting, 70 basis point cut, and the whole world was just like losing its mind, that Monday was not just a one-off day, but that Monday was signification that we were in grave economic trouble. Well, it turns out I don't think we were. And I don't think we were, and the market has proven that out. On Tuesday, we came in and the market rallied, except for a midday sell-off. Wednesday, the market rallied, except for a small midday sell-off. That was just profit-taking. On Thursday, we got economic data, once again, that was jobless claims. Jobless claims are how many people are applying for unemployment. A very key indicator on the state and the health of the consumer and of the employees of this country. The number was really good. Way less people were applying for unemployment. So after that terrible Monday and a good Tuesday and a good Wednesday, we ended up having a major rally on Thursday. So after this doomsday scenario on Monday, all the days that followed, Monday, Tuesday, Wednesday, and now Thursday, with really good economic data, were all bullish. The bears went back into their cave, right? And they bought a bag of chips and they sat down to binge watch some Netflix stuff because they weren't coming out for a while. However, if you think about it, on Monday, the bears came out and they screamed, "I told you so, I told you so," right? I've been telling you about this bear market for the longest time, la, la, la. It didn't take 6 hours before those bears were back in the cave. Thursday was a major day of rally. It went from the bottom left to the upper right. There was no midday sell-off. It was a straight up solid bullish scenario. Then we came in on Friday. Market was a little profit taking, not that interesting. Then we had last week. Last week was a solid week. The market started to rebound. And by now, we are here on the following Friday. And the market is trading at 41,000 the Dow, 5,600 on the S&P. We've taken back 60, 70% of the losses that we suffered on that Monday, right? If you sold on Monday because you got caught up in the catastrophism of the whole scenario, that everybody in the media was screaming and yelling, it's the end of the world, that things are really bad, and this rally is all irrational enthusiasm, and it's all BS. Well, you are now an unhappy camper. It's very important that basically we always joke about it. When everyone is selling, it's time to buy. When everyone's buying, it's time to sell. But never get emotional about your money. Okay? So think about it. If everybody came in on Monday, so the market down 1,000 points, and they said, oh my God, and they listened to the news, and the world's coming to an end and all that, I better sell everything. And they sold everything. The market is up 10, 20, 30%. Stocks are up 10, 20, 30% since then. The tech sector has rebounded 30, 40%.
Yeah.
NVIDIA is back to where it was trading beforehand. So I say all this to say that no one should get it. Look, now everybody should do their own homework. They should come on and listen to me and my good friend from Turkey on Fridays, because we're giving you really good information. The media tends to catastrophize everything and get you very emotional. So at the end of the day, we're sitting here on the 22nd or 23rd of August. I cannot believe that August is almost over. It's already starting to become cool here in New York.
Time flies.
All right, but a short 10 days ago, the market had a massive sell-off, and everyone was talking about the end of the world, that the tech rally was over, and that we should all just be running for the hills, screaming and yelling. Not a fact, not correct, not a good truth. The market tells us what it thinks of all this information. And I would say that the bullish rally has been regained. The levels of 41,000, 5,600 on the Dow and the S&P respectively have shown us that there's money coming into the market, that people have regained the confidence they need. Let's look at we're here on the 22nd of August. What's significant about today is that, so we have a conference that happens every year in Jackson Hole. It's in Wyoming. Yeah. All of the Fed, anybody in finance, they meet. And it gives them the opportunity to say the things that they don't say in the other venues. It's, Jay Powell speaks every 6 weeks on a Wednesday for the Federal Reserve pulpit. He doesn't always say some of the things that he's able to say in Jackson Hole. We came in this morning. The market has rebounded beautifully from the lows of that last Monday. And all eyes were on the Federal Reserve and Jay Powell talking about what was the next shoe to fall, or what was the next foundation to build for a higher market. And we got the latter. Jay Powell came out of the gate. He gave a description of the world the way I do for you every Friday, which is he told the scenario of the world in COVID. He told the story about how COVID, they learned their lesson from the financial crisis, and that during the financial crisis, they threw $800 billion into the market over 18 months. It took 9 years to get back to even. During the COVID crisis, they put $3 trillion in the market in 3 months. We were back to even by August of 2020. We were up 20% in August in 2020 and 28% in 2021. So they learned their lessons, and he understood, and he gave an amazing explanation. I kind of think he must have been listening to me, because his explanation was almost as good as mine. But he gave the same story that I say over and over again on all of my social media podcasts around how this story unfolded around the crash of COVID, the reasons for raising interest rates, and that whole story, and then how over the last number of months we've been waiting for the scenario to change and cut rates. And he said he's apologizing for the fact that he had to really wait until the economic data was sufficient to do this. But he said, finally, I'm standing here in front of you today on the 22nd of August, and the runway is clear. The path is now clear. It is, they've given us all the economic data necessary to cut interest rates. And my plan is that on September, whatever day it is, I'm going to be cutting interest rates. Now, he did not say how much.
Yeah, I was going to ask, because there's a huge discussion going on between 25 basis points and 50 basis points. What could be results of the either decision? And also, while Bank of Japan is increasing interest rates, and Fed is planning to cut it, what could be the effects of the market, those two different aspects?
I understand your question. So the scenario between 25 basis points and 50 basis points is look, right now there's a 70% chance of 25 basis points, a 30% chance of 50. Let's look at the scenarios. We know we're going to get a cut. That's a guarantee in September. Yeah. Short of some disaster happening, we are getting a cut, and basically it's going to be at least 25 basis points. The best case scenario for a 50 basis point cut would be that the Fed waited too long, that they made a mistake, that they're getting bullied, that they are flip-flopping about their policy, and I don't think it will be a good idea. And one last thing is that the economy and the people are going to be fearful if they are now suddenly going from no cuts to a 50 basis point cuts, maybe the economy is worse off than we think. That the economy suddenly, after him not even presenting a scenario where he's cutting rates at all, just suddenly cutting rates 50 basis points, there must be something we don't know, and we have a problem. And the Federal Reserve does not like to have mud on their face. They don't like when there's mud on their face. So my gut is I don't think, short of anything disastrous happening, that they are going to have 50, but we don't deserve a 50 basis point cut unless some economic data comes in that we don't know yet.
Okay.
But I think we're good for a 25. I think people will be, I think if we get a 25 basis point cut, the market will respond favorably and the bulls will take over and the market will rally and we'll see a really solid end to the year. No guarantee we don't have more than one cut this year. I did an interview with Dan Ives, famous tech analyst, yesterday. He believes there's going to be more cuts, 3 more cuts this year, or at least into March 2025. All that being said, a 50 basis point cut is a big deal. It's a bit of a shock and awe situation. I don't think we want to do that, and I don't think the market will respond favorably to it. 25 basis point market rallies, 50 basis point market sells off. That's my best case scenario. So that's where we are today. We've been waiting and waiting and waiting patiently for months and months and months. The scenario is almost a missed opportunity. That Wednesday that I keep harping back to a couple of weeks ago may have been a missed opportunity, but maybe not, because the economic data that came out wouldn't have been any different. So I don't believe it was a missed opportunity. Maybe he should have given us, I don't think he should have cut rates then, but he should have given us a little more clarity then. But he does what he does. He and I are not on speed dial together. So at the end of the day, we're here on the 23rd of August. We finally got what we've been waiting for. The market is responding favorably to it. Okay, the market is up. It was up 60 handles earlier. It's given back some of its profits, but I think it's going to be a positive, solid market. In a couple of weeks, we're going to get the interest rate cut we deserve, and we are impatiently waiting for. I think the market will respond favorably, and that's the best. That's the way the cookie crumbles. It's a beautiful case scenario. That's left is the election. Now, I think everybody's asking, like, what's the difference? Best case scenario for a Kamala Harris or Donald Trump presidency. I don't think either one will have any effect on the market because historically it has no effect on the market. They are different policy-wise. I don't know if either of them have a policy, so I don't even want to make a judgment about that. But at the end of the day, politics play a very, very little role in the way the market is. So I think all eyes are going to be on economic data. All eyes will be on the Fed. The next thing to watch is how the market reacts to the interest rate cut in September, and then also see in the conversation after the cut in September what he says about further cuts this year. Maybe another one in October, maybe another one in December, because we don't want to stay higher for longer. We want to get the interest back in line with the reality of the economy. So I think I've given you a mouthful, everyone. I've given you a great breakdown on what's happened since COVID. I gave you a great breakdown that's happened this year. I gave you a great breakdown on where we are today and explained to you why the sell-off happened on Monday and how we ended up here today.
That was Peter Tuchman. Thank you for joining us. It was always a pleasure to have you here. I would like to thank everyone joining us today. Stay tuned for more TradeZero live session and happy weekend ahead. Thank you.
My pleasure. Bye, guys.